Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into the investment thesis focused on legacy defense contractors. But as you quickly learn when you look at the raw data, this is not about traditional budgeting cycles or political posturing. This is about a radical institutional revolution happening inside the Department of War itself.
That is absolutely the critical starting point. I mean, we are not looking at marginal changes here. We're looking at a foundational reset of how the United States government buys capability.
Absolutely. So let's deliver the core thesis statement for this entire deep dive immediately, because it defines the entire new landscape. The war-fighting acquisition system, or WAS overhaul, accelerates the performance gap, magnifying the strengths of agile, diversified giants like RTX, and it's opening contract pathways for specialized disruptors like AVAV. This forces a highly selective investment approach where, value is contingent on successful execution, and we're looking right at LMT there.
That thesis, it immediately cuts to the heart of the matter. What is happening right now in the Department of War, the DAOGO, it's not minor bureaucratic reform. We are witnessing a systemic demolition job on the old engine, the Defense Acquisition System, or DIS. And that system was slow, it was fragmented, and let's be honest, universally agreed upon as liability in an era of peer competition.
And what defines the WAS isn't bureaucracy, it's urgency. They are tearing out that old bureaucratic engine and replacing it wholesale, structured around one single, powerful organizing principle.
Speed.
Speed to capability delivery. That is the key shift.
Yeah.
Acquisition is no longer a back-office compliance function. It is formally designated as a warfighting function if a process doesn't demonstrably support rapid speed to the field.
It is gone. Just out.
Gone.
And this urgency, it stems from a brutal, honest diagnosis of the three systemic challenges that plagued the old DES for decades. And you have to understand these failures to really appreciate why the WAS is so radical. First was fragmented accountability.
Okay, what does that mean in practice?
It means you had layers upon layers of program executive offices. But when a program ran late or over budget, accountability vanished. It just dissolved into the bureaucracy. No single leader had the authority or, frankly, the incentive to drive results urgently across the entire life cycle of a program.
So no one person's job was on the line if the tech didn't get to the troops on time.
Exactly. Which leads right into the second challenge, which was a truly classic paralyzing government trap. Broken incentives.
The culture of compliance.
The culture of compliance. The entire system rewarded leaders for checking every single box and satisfying every detailed paper requirement, no matter how long it took. The perfect checklist, the perfect audit trail that always trumped a functional system delivered to the soldier or pilot in the field.
Which is just insane when you think about the stakes.
Completely insane. And that failure of incentives directly fed into the third major challenge, which is, a real national security vulnerability, the constrained defense industrial base, the DIB.
Right. Decades of these huge winner-take-all contracts.
That's it. That procurement habit led to extreme market consolidation. We went from roughly, 51 major prime contractors after the Cold War?
Down to about five. 5 giants today.
And that lack of competition, that lack of flexibility is a profound vulnerability, especially when you're trying to surge production capacity. The WAS overhaul is explicitly designed to expand that base.
Okay, so that's the diagnosis. Let's unpack the cure. How does the WAS mandate this institutional overhaul? It's a systemic shift from that culture of compliance to mandating speed to capability delivery.
It is, and it means the Dow is consciously, and this is a big deal, consciously accepting more calculated programmatic risk. They're willing to accept some risk if it means fielding new technology faster than adversaries can develop countermeasures.
So less paperwork, more prototypes.
Way more prototypes. And structurally, they are fixing that fragmented accountability problem right at the top. They've created a new leadership framework by designating the Portfolio Acquisition Executive, the PAE, as the single accountable official for specific portfolio outcomes.
So that's the one throat to choke, so to speak.
That is the one person. And this PAE is empowered to make sweeping decisions, move money, cut programs. It's a level of authority that previous roles just did not have.
And that authority is backed by a financial imperative. We're talking about real teeth here, right?
Oh, absolutely. Incentive pay the bonuses for acquisition leaders and program managers will now be tied directly to capability, delivery time, and mission outcomes.
That's a game changer.
It's a powerful, game-changing alignment of interests. You get paid based on whether the troops get the kit they need, when they need it, not on how neat your file cabinets are.
Okay, so that's the people. What about the tech? How are they fixing the GIB problem, the lack of competition?
So moving to the technology side, perhaps the most critical mandate aimed at fixing the DIB is the full implementation of Modular Open Systems Architecture, or MOSA.
MOSA, you hear this term everywhere now.
And for good reason. It's not just an engineering trend, it's a contractual demand. MOSA promotes interoperability, competition, and crucial technology insertion down the road.
And we need to pause on MOSA because it directly addresses the problem of vendor lock, which has bled the Dow dry for decades. Explain that concept of vendor lock.
Think of it this way. The old DAS created proprietary systems, like buying a mainframe computer 30 years ago. If you needed a new feature, a new radar, a new piece of software, you had to go back to the original manufacturer.
No matter the cost, no matter the speed.
Exactly. That manufacturer had you locked in for the entire 30 or 40-year life cycle of that system. You were trapped.
A MOSA is the opposite of that.
It's the complete opposite. It's mandating open standards, common interfaces, and clearly defined modules, much like, say, the modern smartphone ecosystem. If one module, let's say an advanced sensor or a targeting computer, becomes obsolete or too expensive,
You just swap it out.
you can easily swap it out with a competitive third-party component. This radically reduces lifecycle costs, and most importantly, it forces the prime contractor to constantly compete on value, not just on being the only game in town.
So they aren't just changing the organizational chart and the tech requirements. They are fundamentally restructuring the rules of engagement with industry. This sounds like it's designed to attract new market entrants and expand that constrained DIB.
That's the entire point. The complexity of the old system was, frankly, designed to keep people out, especially nimble, high-tech firms. Now they are actively tearing down that red tape.
And how are they doing that specifically?
We see simplification everywhere in the WES. For one, they are explicitly replacing the slow, complex, paper-heavy analysis of alternatives, the AOA's process.
Which could take years, right?
Years. And they're replacing it with rapid experimentation and demonstration of existing technology. This completely flips the script. Instead of spending 2 years writing a report about what might work,
You spend 6 months building a working prototype and showing what currently works. Validation now trumps paperwork?
that is the new mantra. And for non-traditional contractors, this next shift is arguably the most impactful signal the Dow can send. They are transitioning away from the burdensome and highly specialized government-mandated cost accounting standards, or CAS,
Oh, this is huge.
toward commercially used, generally accepted accounting principles, GAAP.
This is a colossal move. The impact needs to be fully understood because CAS was the Great Wall.
It was a massive financial barrier to entry. CAS required specialized teams of defense cost accountants. It could often take 18 months and millions of dollars just for a new company to become CAS compliant, even for a small prototype bid.
So if you're a startup in Silicon Valley with amazing tech, you're just not going to bother.
You're going to run screaming. By moving a gap, the Dowby is essentially saying, if you can handle standard commercial accounting, you can bid on our contracts. It explicitly reduces barriers for the tech hubs in Silicon Valley, Austin, Boston, all the places that historically avoided government work.
Furthermore, they're taking a scalpel to contracting speed, which is a major bottleneck. The Dow is pursuing concurrent reductions in the application of the Truth in Negotiations Act, or TINA, in situations where adequate competition already exists.
Right. And TINA historically required extensive auditing and detailed cost data submission for every major contract, which is excellent for preventing overcharging, but it slows down procurement dramatically, often by months.
So what's the trade-off they're making?
The WES is making a calculated bet. Where market forces provide genuine competition, they will rely on those market forces, not compliance paperwork, to control the price. They are sacrificing some auditing rigor for speed and competition, reinforcing that idea that capability today is worth accepting calculated risk.
And finally, a huge focus on rebuilding manufacturing and the supply chain, which the WES identifies as a critical vulnerability.
A massive vulnerability. This starts with the establishment of the Wartime Production Unit, the WPU. Its mission is unambiguous: surge capacity, address bottlenecks, and accelerate manufacturing output across the DIB.
And the WPU is backed by a powerful directive to go direct to supplier.
Yes, the Dow is mandating go direct-to-supplier relationships for highly critical subcomponents. Think about things like specialized solid rocket motors, which are facing a huge demand spike right now, or advanced radiation-hardened sensors, specific grades of titanium forgings. These are the choke points.
And the reason for going direct is twofold, right?
Yeah.
First, it's designed to bypass the prime contractors in specific critical cases, so you avoid unnecessary pass-through costs and fees that add zero value.
Correct. That's the first reason. And second, and perhaps more importantly, it allows the Dow to fix supply chain weaknesses directly. They can inject capital and expertise right down to the raw materials level. The prime contractors, they remain the integrators, but the Dow is asserting control over the most fragile parts of the supply chain, the parts that determine whether they can achieve wartime production capacity or not.
So we have this tectonic system-wide shift in how the Department of War operates, demanding rigor, speed, and execution. Now, let's apply this new was lens to the major players in the market, starting with the one analysts currently view as the strategic model for resilience, RTX Corporation.
RTX is, it's essentially designed to absorb these shocks and thrive under the was regime. It's the preferred hybrid executive because of its meticulously balanced, roughly 50-50 commercial defense split.
And this structural balance captures what we call dual tailwinds.
Exactly. On one side, you have the stable, long-term defense spending from its Raytheon segment, which is a foundational pillar of global security. On the other side, you have the post-pandemic supercycle in commercial aerospace, driven by Pratt & Whitney engines and Collins Aerospace components.
This dual market strategy is an absolutely elegant design for resilience.
It really is. If the political climate or temporary budget cycles slow defense spending, commercial aftermarket services and aircraft demand pick up the slack, and vice versa. It provides an immediate, robust earnings floor, and it significantly mitigates the single-sector risk that pure-play defense companies face. And right now, both sides are operating in a highly lucrative, synchronized moment of acceleration.
That structural resilience, it translates directly into superior execution on the balance sheet. In their recent quarter, RTX reported a very strong 9% organic sales growth.
Which is remarkable for a company of that size.
Right. And that robust top-line performance drove a corresponding 19% increase in adjusted segment profit, coupled with consistent margin expansion. This isn't typical.
Not at all. And that superior performance is built on a massive foundation. A record $251 billion backlog. That's up 13% year over year. But to understand the true demand acceleration, you have to look at the book-to-bill ratio.
Which is staggering at 1.8.
It's staggering. 1.86. That means for every dollar of finished work they shipped out, they secured $1.86 in new firm-funded orders. Demand is radically and continuously outpacing their production capacity.
This sounds almost too good to be true, but their ability to sustain this is often credited to their proprietary internal efficiency engine, which they call the CORE operating system. The management team credits CORE with enabling 6 consecutive quarters of margin expansion. We can't just gloss over this. What is CORE?
It's essentially a bespoke, integrated digital operating system applied across their entire enterprise, from design to delivery. Think of it as Six Sigma married to digital engineering. CORE mandates the use of digital threads, which link design data, manufacturing processes, and supplier management in real time.
So it gives them total visibility.
Total visibility. This level of vertical integration means they can spot inefficiencies, reduce waste, and enforce quality control much faster than competitors using legacy fragmented systems. In the context of the WAS, which demands rigorous efficiency, CORE is why they're delivering margins while others are struggling with cost overruns.
However, this financial strength is about to be tested by a monumental internal crisis, the GTF powder metal crisis at Pratt & Whitney. This is critical because it's a temporary headwind that only a company with RTX's sheer size and operational depth could absorb without collapsing the thesis.
And this is a major real-world operational failure. The airlines using these planes are furious. The crisis stems from a material flaw in the powder metal used in high-pressure turbine discs of the PW1000G geared turbofan, or GTF engines. These power the highly popular Airbus A320neo family globally, and the flaw necessitates accelerated inspections and engine removals across the fleet.
And the logistical headache for the airline industry is almost unimaginable. Initial optimistic repair estimates were around 60 days per engine.
Right, that's what they thought at first.
That estimate has ballooned. It's now expected to take up to 300 days per engine for inspection and repair.
300 days. That is nearly a year of downtime for a critical asset, an airplane that should be making money. And RTX is now on the hook for those costs and customer compensation.
The financial exposure must be severe.
It is. The company is expecting a massive $1.1 to $1.3 billion cash impact in 2025 alone. That's for customer compensation, rental engine costs, payments, credits, all related to this remediation effort. But here's the crucial takeaway for investors. Despite facing a multi-billion-dollar real-world failure, RTX is confidently managing it as a temporary headwind.
And they can only do that because of their overall financial momentum, that dual tailwind model. It allows them to absorb this strain without dramatically derailing the long-term thesis or cutting their defense investment. It highlights the strategic superiority of diversification.
And finally, we circle back to the WUS. RTX plays a foundational role in the defense industrial base. They build the F-135 engine for the F-35 fleet and key missile components for the Patriot systems. Their response to the supply chain vulnerability aligns perfectly with the WUS mandate.
You're referring to their proactive supply chain management. They didn't wait for the WPU to mandate action.
Not at all. They deployed 550 engineers directly to their suppliers, and not just to audit, but to assist with quality control, process improvement, and material management. That is the very definition of the operational rigor the Dow now demands through the WUS direct-to-supplier relationships.
So if the WUS is designed to expose poor execution and reward efficient suppliers that proactively fix the DIB,
then RTX appears uniquely engineered to thrive under this new demanding regime. They are fixing their internal issues while simultaneously positioning themselves as the go-to partner for the Dow's most urgent modernization priorities.
That brings us to the pure-play defense contractors, starting with Lockheed Martin. LMT. LMT is positioned differently. It's the execution-dependent value play. It trades at a very attractive, low blended PE ratio of 17.5 and boasts a substantial $165 billion backlog. But let's be honest, that valuation is low for a reason. It is struggling acutely with high execution risk.
The evidence of this struggle is stark, and it's the elephant in the room for investors. LMT reported that its operating profit fell a staggering 65% in Q2 2025.
65%, that's a collapse.
A collapse. And this drop was not an isolated incident. It was primarily due to F-35 program delays and compounding charges from a wide range of program losses and cost overruns across its portfolio. Essentially, they're being forced to eat the costs of failure.
The vulnerability here is immense due to what we call program concentration risk.
Okay.
The F-35 program, arguably the most important defense program globally, accounts for roughly 25% of LMT's total sales.
A quarter of their business on one program.
Right, so any delay, particularly the persistent setbacks in the crucial TR-3 update, disproportionately impacts their performance and profitability.
And we need to explain what TR-3 is, because it's the specific friction point here. TR-3, or Technology Refresh 3, is a massive set of hardware and software upgrades. They're necessary to modernize the F-35's processing power and enable it to utilize new weapons and fully integrate its electronic warfare capabilities. It is the core update that brings the jet into the next generation.
And the problem?
Persistent, complex technical problems, particularly surrounding the hardware-software integration of the new processor. The delays have stretched on, impacting when LMT can actually deliver finished jets to the government.
And crucially, when they can start collecting the corresponding milestone payments.
Exactly. That uncertainty and the resulting charges are what drove that 65% profit drop.
This is where the WUS implication becomes critical. The WUS is instilling a warrior ethos focused on speed and accountability, tying that PAE's pay directly to capability delivery time.
Right. And this new ethos will severely punish chronic schedule setbacks and execution failures. For LMT, that attractive 17.5 valuation only delivers if they can successfully execute a rapid operational turnaround that meets the high standards of rigor the Dow is now imposing.
But let's play the devil's advocate here. LMT has been dealing with complexity for decades. How likely is it that they can truly achieve that turnaround, especially with such a massive dependency on one program? The history of government contracting shows program delays are nearly inevitable.
That's the core skepticism that gives LMT its value play status. The market is saying, we acknowledge your backlog, but we doubt your ability to execute on time, so we're discounting the stock steeply, unquote. The West is forcing LMT's hand. If they fail to fix TR3 rapidly, the Dow has mechanisms, thanks to that new PAE accountability structure, to impose penalties or even look for alternatives in new modernization efforts. It's a high-risk, high-reward bet on managerial and operational change under intense external pressure.
Contrast that high execution risk with Northrop Grumman, NOC, which we view as the stable pure-play income anchor. While both LMT and NOC are pure-play defense contractors, NOC is generally viewed as having better diversification across its portfolio, and crucially, a better track record of consistent execution than LMT.
That's right. NOC is focused on foundational, next-generation platforms that are truly essential to national security strategy. And because of that, they're highly resilient to budget cuts. We're talking about generational modernization efforts, specifically the B-21 Raider long-range bomber program.
And the Sentinel ICBM replacement program.
Yes, both are anchor programs.
Explain why they are considered multi-decade anchors that guarantee stability, regardless of short-term political wins.
Well, these programs solve strategic gaps that the U.S. military simply cannot tolerate. The B-21 is replacing aging B-1 and B-2 fleets and provides critical deterrence capability in the Pacific theater. It's entering low-rate initial production right now. The Sentinel program is replacing the aging Minuteman ICBMs, which are decades past their original design life. These programs are not optional. They are the bedrock of strategic deterrence for the next 50 years. This provides exceptional demand stability that is politically and strategically immune.
And that strategic stability reinforces their financial picture. NOC saw its segment operating income soar by 65% in 2024, largely driven by improvements in its aeronautics segment, which includes the B-21.
And demand remains very strong. They had a 2024 book-to-bill ratio of 1.23, so they're securing $1.23 in new orders for every dollar of work completed. And sales growth is projected to remain steady at 3 to 4% in 2025.
But for investors prioritizing stability and return, NOC makes a remarkable and consistent commitment.
They do. They pledge to return 100% of their free cash flow to shareholders through buybacks and dividends. 100%. With FCF expected to see a 14% average annual growth through at least 2027, this makes NOC an exceptionally reliable income play in the pure defense space. If you're looking for durable, high-visibility cash flow in the sector, NOC stands out.
So we've analyzed the hybrid giant built for resilience, RTX, and the divergent pure-play contractors, LMT and NOC. It's fascinating that the established giants are battling execution risks and supply chain nightmares. But this whole overhaul was also designed to dismantle bureaucratic barriers and bring in new blood.
Precisely. The was explicitly favors agility. And let's look at how the shift benefits someone who operates entirely outside the traditional prime contractor model and benefits directly from that regulatory streamlining. AeroVironment. AVAV.
AeroVironment is the specialized disruptor, benefiting from a massive, irreversible secular shift to drone warfare. Global conflicts, particularly the war in Ukraine, have served as an undeniable real-time lecture for military planners worldwide, proving the overwhelming, lethal effectiveness of low-cost, small systems drones.
They are showing that cheap, disposable, lethal capability, sometimes costing only tens of thousands of dollars, can threaten and destroy multi-million or even billion-dollar systems. And AVAV is the clear leader in the small systems drone space, specifically with their Switchblade loitering munitions.
And the demand acceleration is massive, both domestically and internationally. We see reports that Taiwan is moving to buy 1,000 AVAV attack drones for its armed forces as part of its asymmetric defense strategy. That is the definition of accelerated international demand for proven modern capability.
And this agile business model benefits directly from the systemic changes baked into the WAS. Remember how the WAS replaced the slow, document-driven AOAs with rapid experimentation and demonstration? That is tailor-made for a company like AVAV.
It changes the entire sales cycle for them.
Completely. Instead of needing years to write a perfect 500-page proposal based on abstract requirements, AVAV can rapidly prototype, demonstrate proven drone technology in the field, and immediately move toward a purchase decision because the capability has already been validated in a relevant environment.
The ABA philosophy, moving to solutions-based acquisition over requirements-based acquisition, creates a clear, faster pathway for AVAV's proven drone technology to reach high-volume production.
Yes, and they're maximizing the use of flexible contracting tools like other transaction authorities and commercial solutions openings. These tools allow the Dow to bypass significant portions of the old compliance red tape that plagued the DAS.
Financially, AVAV's funded backlog reflects this surge in demand, soaring to $467 million. That's a substantial 25% increase year over year. But here's the critical warning for investors moving into this high-growth space. This growth potential comes at a very high price.
It does. AVAV trades at a high blended PE ratio of 50.9. Now, contrast that with LMT's 17.5 PE. That disparity tells you everything you need to know about market expectations.
A 50.9 PE means the market expects AVAV to execute flawlessly on its projected high annual growth. It's priced for perfection.
Price for perfection. LMT's low multiple, conversely, suggests the market has severe execution concerns and wants a steep discount for accepting that risk.
And we must note, AVAV isn't immune to margin pressures. They've experienced margin compression due to a shift toward higher volumes of lower-margin loitering munition systems, or LMS, revenue. So while volume is up, margin is tight.
And this naturally leads us back to the strategic debate. Elon Musk famously called F-35 producers idiots for investing in manned jets instead of advanced drones. Now, while Lockheed Martin is certainly adapting, pushing hard on integrating manned systems with unmanned systems like the Collaborative Combat Aircraft, or CCA, the explosive growth and undeniable importance of dedicated drone systems like AVAV's Switchblade is impossible to ignore in this new WAS environment.
The new rules of the road are written to favor companies that can solve operational problems quickly. Whether they are small disruptors like AVAV leveraging regulatory streamlining, or massive integrating giants like RTX leveraging organizational rigor.
This is a fundamental divergence. The WAS is forcing the industry to adapt to two extremes: the hybrid, diversified giant that can manage complexity in supply chains, and the hyper-focused disruptor that can exploit speed mandates. The companies stuck in the middle, struggling to shed the old compliance culture, are the ones facing the most risk.
Let's synthesize this entire discussion and deliver the final verdict on the investment case under the WAS regime. The overwhelming conclusion here is that the warfighting acquisition system accelerates the performance gap between executing giants like RTX and NOC and those struggling with legacy execution, notably LMT.
The new system demands rigor, accountability, and speed, and that forces a highly selective investment approach. We've defined three critical takeaways for the capital markets, focusing explicitly on execution and strategic alignment with the WAS mandates.
First, RTX. The hybrid model is strategically superior. It is fundamentally diversified, operationally rigorous, and perfectly aligned with WAS mandates to fix the defense industrial base. They're doing it through aggressive supply chain management and directed supplier initiatives. Their demonstrated ability to absorb the multi-billion-dollar GTF crisis while raising full-year guidance is definitive proof of their operational resilience and strategic superiority.
Second, LMT. The value play remains high risk. While the stock trades at an attractive multiple, success is entirely contingent on LMT executing a rapid operational turnaround. A turnaround that can successfully deliver complex programs like the F-35 TR-3 update and meet the high standards of speed and rigor imposed by the WAS. The system will penalize chronic delays, and LMT has demonstrated significant high execution risk compounded by its F-35 program concentration.
And third, AVAV. Specialized disruptors benefit immensely from this systemic change. They're capitalizing on the secular shift to drone warfare and directly benefiting from the WAS's shift away from compliance bureaucracy toward regulatory streamlining, flexible contracting, and solutions-based acquisition. They represent the high-growth, high-multiple end of the thesis.
But we have to address the remaining sector risks that could derail even the best execution. Does the program concentration risks, such as LMT's F-35 exposure representing 25% of sales, or general political volatility, like the market fear surrounding the potential for a new administration to push a radical Department of Government efficiency agenda, does that mean the sector is too high risk for the average investor?
While political shifts may cause short-term market anxiety and the Department of Government efficiency narrative is always good for a headline shock, the durable anti-cyclical demand is fueled by intense geopolitical necessity. I mean, look at the modernization mandates. The B-21, the Sentinel ICBM, strategic deterrence in the Pacific. These macro tailwinds remain firmly intact, regardless of temporary political leadership.
The key realization is that the macro tailwinds are only available to those who can execute. The WAS has changed the barrier to entry from having political connections to having operational rigor. The rules of engagement have shifted entirely.
Which leads us to the final provocative thought for you to consider as you examine this sector. The Department of War is now consciously replacing lengthy paper-based studies, such as the old Joint Capabilities Integration and Development System, or the AOAs, with mandatory field experimentation and rapid demonstration. This inverts the entire acquisition process.
Think about the implication of that inversion. For investors, the ability of a defense contractor to rapidly field a working prototype now and scale it quickly through digital engineering and superior supply chain management matters fundamentally more than having the perfect proposal written for a program 10 years from now.
The WAS has fundamentally changed the criteria for investment success. It's no longer about maximizing the bid, it's about maximizing the delivery.
Capability, not compliance. That is the future of defense investment.
Risk defined, portfolio protected.